Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
No, Fugazi. It's fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
Right.
All right? Right.
Sunday afternoon, here we are, back again for another weekly market recap, although a little bit of a late stage recording this week. I was out of town yesterday, so couldn't get at it. So, let's have a look at what the market did this week. But spoiler alert, not a lot. But we have economic data coming out, especially, on the inflation side of things. And CPI came in at 10 basis points in line with expectations, although people were screaming for a probable hotter than expected print. Didn't happen, right? So here's what we got. And I guess the market reacted particularly neutral to this one because at the end of the day it was in line with expectations. So which brings the year over year at 3.4. So not huge movements, although if you want to build up the case for the current inflation wave being peaking out, you see it went up and now it looks like over the last two prints it's coming back down a notch, considering what oil did, right? At the end of the day, one of the bigger inputs in this one, it's going to be energy, of course. I think still we are not seeing runaway inflation. And again, it's not the first time, right? It was the tariff scare first, and we got Iran. So, who knows what's going to come next. But so far, it's not really running away. So I would say, let's put it in the positive columns for now. And what else? The core, actually, if you strip out food and energy, the more volatile items, it's around 2.5%, right? So, at the end of the day, again, not a huge emergency for now, right? As expected. At the end of the day, being particularly vocal on this one, wasn't expecting a huge impact on inflation on a mid-term type of horizon, and so far it didn't happen. So hopefully it keeps on going like that. Then we got the producer price inflation, so PPI, which again came in at 0, basically, which was a little bit below expectations. And again, if you consider that if you have inflation on the producer side of the equation, then it should be, brought up to the consumer side. These last two prints, they don't seem to confirm we're going to see sustained inflation pushes in the coming weeks. So again, nothing to see here for now, although government data, right? The real rate of inflation is going to be different, maybe most likely subjective, depending on what type of consumer you are. But at the end of the day, whatever you think about these data, are they accurate or not? Are they fake? Are they fabricated? Yeah, whatever. This is what the market is going to look at. So it doesn't matter what you think, what I think, right? The market is going to run off of these numbers. We got retail sales as well, and they came in very poorly, minus 60 basis points against a forecast which was for a positive 10 basis points. So, again, same discussion as usual. They are not adjusted for inflation. So, if you add inflation on top of it, they are even worse than what they look like. And they already look bad. Even with this one, if you look at the control group, which is, basically it takes out food, services, building material stores, gasoline. So it's kind of like some sort of a version of the core retail sales. If you apply the same logic we do apply to CPI. And again, it came in negative. So, at this point, we have, for the month of August, all the data we needed. We had the labor market data, which again, NFP came in very soft. Negative, right? Plus the revisions, and now you see inflation not really ticking up or giving signs of acceleration to the upside. Again, I think the economy it's cooling off a notch, right? So I don't see particular inflationary pushes unless you have something going on supply part of the equation, say supply constraints, more problems in the Strait of Hormuz, or more supply chain breakdowns or whatnot, right? But other than that, I've never been so confident that we would have seen inflation skyrocketing again, all right? And then what? Michigan consumer sentiment, again, on the low side of the spectrum for the last 10 years. I'm not really paying attention to this one at this point. Although, if anything, this time around, I think I've seen that although it's very politically biased, right? Even some, good cohort or a good part of the cohort of the Republicans in this one, they started to judge the economic situation not so cool. So, it's not just the Democrats, because of course the Democrats, if you have an administration which is Republican, the Democrats are always saying, yeah, no, the economy sucks because, Republicans are in charge. And the other way around when you have some Democrat in charge, right? But again, this time around, it seemed a bit more unanimous, although, again, it could be just very short-term fluctuations even in that one. To close in on the inflation chapter, again, nothing new to see in here. Break-evens, five-year forward, nothing to be seen in here. So I guess, again, nothing really new. If anything, after all these data are passed behind us, the market looked through it. And again, as I told you 2-3 weeks ago, let's wait for this one to flip, because, a little bit of that was expectations. I wasn't expecting huge inflation, impacts. And if you remember, I mean, at a point that there was like 70 on the right and 30 on the left. And as you can see, it almost flipped completely, right? So no expectations for a hike next meeting. And again, I think if anything, if I was the Fed, right, I would just hold rates where they are. They are restrictive enough, in my view, right? Other than that, I don't think there's really anything else to look at in here. So let's jump into the chart straight away. Again, nothing really huge happened this week. If you look at the DXY here, we are still hovering around the same level, which was anticipated support. It went sideways for 2 weeks, and we are still there. And again, the other currencies are pretty much the same. The euro is grinding back into this old level or area of support. And it seems like he may want to try a push higher. Correspondingly, the DXY should attempt a push lower. But again, since we're talking about a consolidation up until the point there is no resolution, just wait for it, I guess. The pound still drifting higher, even in a much more pronounced way than the euro. So cool for the pound, I guess. The Canadian dollar stalled a little bit around that pivot that we were looking at, and it looks like it tried to break to the upside. So again, will it be another type of swing on the upper side of these relevant level? And then we'll see how we can get. Swiss franc, not really going anywhere. If anything, maybe drifting a little bit lower, but still in this tiny little box in here. So huge consolidation at the end of the day. The Japanese yen, after the coordinated intervention, it drifted back down a little bit. So it gave back a little bit of what that huge move to the upside was, because, from the very bottom of it, it was what? A little bit more than 5% to the upside. And after the spike, we are now 2.60% down. So, kind of in the middle of that, right? So again, just wait for it a little bit with a huge caveat that up until the point it was just a BOJ. Could have just very easily deemed the entire dynamic as, it's going to be temporary. Now the Fed is involved, so maybe, who knows? Although so far the market looks like, again, it looked at it and said, well, yeah, sure. Even if the Fed is involved now, we are still selling it. Or at the very least, no one is buying it with conviction, right? So, I guess it's a very strange dynamic, because it looks to me like the Fed, it's basically fighting two wars. Or not really the Fed, but the United States maybe as a whole. If you consider the administration, the Fed, the Treasury, on one side, they impose tariffs on Japan, and they struck deals for Japan to commit investments into the United States, which would bring to what? Japan having to sell yen to buy dollars to then invest in the United States, which would weaken the yen, right? Same with tariffs, right? But on the other side, the Treasury and the Fed are supposedly propping up the yen to avoid a spike in yields by the same dynamics we were describing last week. So again, it seems like they're both fighting for different things, and they can't have both. So I don't know how it's going to end up, which is why I'm a little bit on the wait and see mode. Although, long-term trend here, it's obviously down yet. So, And again, I think last week I mentioned, I closed in the paragraph on the yen saying, well, you know what, I think at a point the US would prefer, or if they had to choose, they would prefer to bail out Japan rather than Europe. Now, on that note, let me add that I forgot to mention that in order to perform this coordinated intervention, they didn't sell dollars. They sold euros, which again tells you a lot, right, about the preference. Now, you may say, well, if they don't sell dollars, they don't need to actually impact their own balance sheet if they sell their euros reserves. Well, so they're just swapping one foreign, currency reserve for another. And the majority of that, I think, as for the US, I'm not 100% sure, so don't quote me on that. But I think the majority of the euro reserves that they hold it in French government debt, most likely German. So the bonds, pristine collateral. At the end of the day, if you look at Germany up until 2 years ago, it was the best performing economy on the European continent. Very good, management of the debt and fiscal policy. So it was considered some sort of a good thing to hold German debt. So yeah, that's the story. They just liquidated a bunch of that. They got the euros, they swapped the euros, and they actually bought yen with that, right? So that would be it for the main currencies we usually look at. The others, again, nothing really changing here. Chinese yuan, always the same, drifting up. South African rand, it went sideways this week. Russian ruble kept on drifting down instead, again, giving back the entire move to the upside. Same for the Brazilian real, which completed the swing up fully now. It's back to, the point of origin. Indian rupee went sideways, but still on the weaker side of things. And the Australian dollar kept on drifting to the upside, back to the swing high right here. So it's going to be interesting to see what's going to happen at this level right here, right? Also big figure, right? 70, 71, something like that. So, we'll see. I'm not particularly interested in Australian dollar, to be quite honest. Other than that, what else? Bitcoin did fuck all this week. If anything, maybe, on Monday it came down and then it just kept on drifting to the downside. But still, we are operating in this huge range at this point, which is going around since basically the beginning of July. So a little bit more than a month now. And again, my objections, my reservations about Bitcoin is, why, if the rest of risk on assets are performing relatively good, if you think about indices, if you think about even gold recently, right? Why Bitcoin is not catching a bid? That was my doubt. And again, in a market which is performing well in a particular time span, if I see an asset which is not participating, naturally, me or you or anyone else, you should start asking questions. Again, I hinted at the fact that maybe it's the Clarity Act, which would allow much more, prominent capital to be poured in with a legal framework. Maybe it's that, or maybe it's just that investors are not confident enough in this one. I don't know, right? If you consider, the stretch, right, could also be that Bitcoin cannot go up, maybe, and again, it's just a thesis. I'm not saying I got data supporting it. Maybe Bitcoin is not going up because Sailors is keeping on selling a little bit of that, small tranches at a time to do what? To prop up his preferred, his crypto bonds or whatever you want to call them, right? Which, quite honestly, they actually recovered pretty good. I mean, they are back to what? 94, almost 95. They're coming back from 75. So it's not a move which you should discard. Same as you shouldn't discard it to the downside. Should not discard it now to the upside, all right? So again, for me, Bitcoin, it just stays in a limbo. And the more it goes sideways while the rest of the market is performing well, the more I see weakness. And I'll still keep on thinking about a retest of these lows first, and then we see what's going on there, right? And supposedly, if you want to remain bullish, still in the context of this huge consolidation, you would need to see this area overall holding, right? 60K at this point, it looks like a good pivot for the market, right? So, I mean, I'm not saying we need to test it. We are not that far away, to be quite honest. And it looks like, we pumped down, another attempt down, another attempt down, another attempt down. So it looks like every time it catches a bit, it's immediately faded. So, maybe at least this swing low right here will be tested. We'll see. And then we'll see what direction will be there, right? That's where you want to see it holding. Otherwise, you open the gates for a much more severe move to the downside, I guess, all right? As for gold, again, the bias last week was good. I mean, we pumped out of this consolidation, but we were hitting or almost hitting resistance. It looks like we hit that resistance. There wasn't a huge reaction to the downside, which is good if you want to be bullish, right? That should be good. I mean, you didn't see it being tapped and then immediately price being rejected lower. And actually, again, if you see resistance being hit and price actually keep on moving and trying to push into it over time, that should give you a little bit more hope that you're going to be able to break through, all right? By the same token, up until the point you are not through, it's basically the same situation as last week. You don't buy straight into resistance. You wait to see what's going to happen. If you are bullish overall, just wait for the reaction at resistance and maybe try to buy it lower. Or, like in this case, if you don't know yet how it's going to play out, wait for resistance to be broken, bullishness being confirmed, and then try to get in on a following pullback. It's going to be at a worse price, maybe, yeah, sure, but with a little bit more of confirmation. Again, it's always a trade-off, right? Either you get risk-reward or you get a little bit more confirmation. And again, if you go in with less price information, aka less confirmation, most likely you're going to have more risk-reward. If you wait for confirmation, sure, probably your risk-reward will be a little bit more skewed to the lower side of the spectrum, but your odds might be, improved, right? So pick your poison, I guess. Other metals, not a lot. I mean, same as gold, they went up and then they just went sideways this week, both for silver in here, platinum, same. Palladium had a nice move to the upside, and then, basically Palladium did what, played out one of the scenarios that I was forecasting for gold last week. Copper, what about copper? I mean, fresh new all-time highs. It drew back a bit. If it was another market, I would say this is weakness, but considering how copper usually moves, I'm not calling it weakness at this point. Two reasons. One, new all-time highs last week. It's hard to be bearish, obviously. Two, we are hovering around this level, these two previous highs. So up until the point we are there, and it looks like we had a test very deep into them, and we found buyers. So for now, can't be bearish. So, up until the point even short term, how would you get bearish on copper? Probably below here, right? I would need to see the market cracking back below this level right here. all in between from this low to this high. It's just a new dealing range. So let's wait for price to work it off and see what's going to come next. But obviously, if you look at the trend, your bias should be bullish up until the point you're told otherwise by the market, right? What about oil? Yeah, again, it came up on a Monday and then it just went sideways for the rest of the week. So, opened at 78 more or less and closed at 82. A little bit more less volatile compared to previous weeks, which I would say is good, no matter what you think. But if you think about the impact of oil on other markets, especially indices, for instance, right? Even if you think it's going to be a little bit more stubborn than what a lot of people would anticipate and stay at relatively higher than expected prices, if volatility comes down a bit, it's still a positive for other risk-on assets, right? You don't want to see it swinging 10, 15% per week because that volatility would be reflected in other assets and it would make your life a little bit harder, I guess. Kind of non-eventful week for oil. But at least, at the very least, you could say, we bounced high, low, lower high, now lower low. Is it another lower high? And hopefully we can bring it back down in the, mid 70s. Hopefully. I mean, I say hopefully because of the electricity bills or because I'm more involved in other risk on assets. But, I guess if it comes back down, 97% of people on the planet would be relieved, I guess, unless you are not betting to the upside, right? Or you are a refiners or you are betting on some, oil ETF or whatever. But other than that, the majority of us would be pleased if we can reach into lower prices, right? So, not a lot to say. We are still above this pivot, which 77 or 78. So I would like to see it traded lower, but for now, it's some sort of a decision point, maybe. All right. So we'll see what's going to happen next week. As usual, very news driven, right? So wait for potential tape bombs to come in, depending on a tweet, depending on, I don't know, a missile being fired or a mine exploding and damaging a vessel, whatever. So, this is the name of the game if you are playing the oil market or the energy market in general, I would say, right? Then after that, yields, which and they are starting to diverge once again. As you can see, the short end came down this week, bit of a bounce on the last trading day of the week, but the 10-year was pretty much sideways. Instead, if you look at the long bond, let's zoom out a little bit, it was a week mostly to the upside at the end of the day. While instead, if you look at the weekly candle in here for the 10-year, looks like you have the same shadow to the upside and the same to the downside, and a body which is relatively tiny compared to the others in the near proximity, right? While instead, again, the short end is coming back down a bit more. So a little bit of divergence there. I think, we had a few auctions this week. If I'm not mistaken, it was a 10-year and a 30-year. The 30 years auction was particularly, misspoken in my view, because everyone went to say, this is the highest yield over the last since 2001. The auction have to allow to buyers and to bidders in order to actually sell all the treasuries. Yeah, that's true. But by the same token, if you look at the bid to cover ratio, it wasn't one of the worst data over the last 3, 4, 5 years. So is it true that the market is demanding a higher yield in order to buy the debt? Yeah, that's true. Is it true that the market is not financing or it's not willing to buy the treasuries anymore? No, it's not true. So that just means that the US is still able to borrow, but at a higher rate than what it was able to do 2, 3, 5 years ago, right? So, but that doesn't mean that the government is going to go bankrupt tomorrow morning because nobody's showing up at the auctions, right? So just put things into context. And if you look at previous episodes, like 2011, 2012, or after the 2008, or right before the 2000.com crash, yields tend to diverge a bit when you have a process of inversion or uninversion. So, short-term fluctuations, they tell you very, very tiny little things on the whole. These are things that you should assess in terms of weeks, if not months. So, they play out really slow. But, other than that, or for now, I don't really think there is a lot to look at in here. I mean, at the end of the day, for a portfolio or long-term portfolio, I wouldn't mind to add a little bit of treasuries, considering the yield that you could lock in for the next 10 years, let's say, right? Plus, what else? There was another thing. I just forgotten it. It was about how Besant is running the treasury right now. You see that, they are shifting the issuing to the short end of the curve so that they are not forced to lock in such high rates on the debt, right? And the interest burden can be contained if you keep on issuing at the short end of the curve, because, when that debt comes due, you can roll it off and potentially take advantage of rates coming back down. So at the end of the day, shifting the issuance to the short end rather than the long end, it's just a way to avoid to lock in higher interest rates burden for a longer time. And at the same time, I think it's also a bet on the fact that even long-term interest rates will be lower into the future, right? Because this is not something that the Treasury or Besant in this case can keep on doing for infinity, right? You can't keep on funding medium to long-term type of investments or expenses with short-term financing. It's the same dynamic that sooner or later will bring a bank to suffer a bank run. There is a mismatch in duration in between the assets and the liabilities, right? So again, I think this is a bet that the Treasury is making right now. And I think, they expect to see it paying out relatively quickly. And again, we're talking macro, so relatively quickly could also be 1 year or 2 years, who knows, right? No, I'm just saying that. Okay. So other than that, I don't think there is really anything else to say about bonds. So let's have a look at the stock market instead. And as you can see, this week, since markets really didn't move a lot, getting very fast, all right? As for the stock market, what we see is that we opened up on Monday on the two major indices, and we are looking at the futures as usual. Monday was pretty much a sideways day. It went up a bit and it came back down, but overall didn't move a lot. No particular direction, all right? Nasdaq pulled back a bit more compared to where it opened, all right? Then on Tuesday, they both dumped. Again, it wasn't a huge dump, but they just drifted lower overall throughout the day, right? And then, you have some sort of a low of the week being put in, and then for the rest of the week, they kept on bouncing and coming back again higher, up until the point you get to Thursday, and they both shoot to the upside. And then they spent the rest of the week, which basically Friday, the last day of the week, pulling back a little bit, retracing a little bit of that move to the upside, and then just going sideways. The week closed, that there was that power hour at the end of the session, I guess, with a little bit of buying. So probably there was a little bit of profit taking in here, especially because if you were looking at price action in real time, it wasn't just plunging. You weren't looking at, 100 points move in minutes. You were looking at a market which was going down 30 points, coming back up 15, going down 30, coming back down 15. So it was some sort of a distribution down. It was looking like profit taking, especially the way it started to develop, right? So, which brings to the bigger picture, which again, still, if you look at the entirety of the week for pretty much all the indices, fresh new all-time highs for the Russell, The Dow, it's behaving a little bit like copper, right? A clean break to new all-time highs. It's drifting back a bit, kind of retracing, pulling back, but it doesn't look like exhaustion and blow off top, right? It's just normal. The market is getting back into balance after being out of balance for 1, 2, 3, 4, 5 days. So nothing bearish there, of course. The S&P, new highs. So again, right? Can't be bearish on that. And I think, either we use these 7,800 level as a launchpad for more upside from here, or what you could see, again, considering that at the end of the day, August and September, seasonally speaking, are on the weakest side of the seasonal return, right? It's totally possible that we pull back a bit from here and we get back to test the old all-time highs and see what happens there, right? So the way I would turn back to be a little bit more bearish if we fall back into this range, right? But at this point, whatever test we may have, I'm not saying we're going to have it. Actually, this structure right here, for now, in the very short term, it's much more bullish than what you could think. I'm just saying, if it doesn't start to run from here, right? And considering the seasonal period, big if, right? If you see it struggling and then coming back below here, at this point you could expect a test in here. But if that test holds, we are still on the green for more upside getting into October, November, whatever. Now, bear in mind, as usual, in November, we are going to have to deal with that tiny little thing called midterm elections, right? So who knows what's going to come from that. The NASDAQ is still trying to catch up, relatively weaker yet, of course. But even the way the NASDAQ moved this week, it basically moved exactly as the S&P, right? It just the initial spike to the upside was a little bit more subdued. And again, also consider the fact from where they were coming from, right? The S&P never broke this low right here. The NASDAQ actually did. So it's normal and it has a lot more terrain to catch up with, right? But it's a market which is hard to be bearish for now, at least if you just judge on price action. Then if you want to start to add in all the talks about fundamentals, the AI bubble, the K-shaped economy, labor market deteriorating, sure. But are they stories which are going to hit the market today or next week? I would say probably not. I mean, you never know, of course, 100%, but probabilistically speaking, I don't think those are matters and problems which are going to impact the markets negatively next week or next 2 weeks. Then, other than that, we'll see. If you look at this other layout, everything is kind of cool for now. I mean, all moving averages are sloped to the upside, and you see the market is using the faster ones to rally off of. So, yeah, for now, it's all good. No divergences in here for now on both RSI or stochastic. MACD still on a momentum buying signal. So, I mean, again, nothing to be bearish for now, right? So keep riding it, although, of course, as usual, just be mindful of the risks, right? You never know, right? Just to closing, I mean, to reiterate, you got the seasonality. September seems to be the weakest. Although, again, July at the end of the day, which is one of the best performing months, if you remember, turned out to be negative this time around. So who knows, right? But I think it's just worth having the concept in the back of your mind just for the sake of it. Also remember that we are looking at a very low VIX while we are approaching a segment of the year where historically we saw a little bit of upside in the VIX. I think for now it closed in at what? Let me check. Yeah, 14, low 14s. So yeah, really, really low. And, lower than, normal. Because if you look at the average from basically the 90s up until now, we are below the average, right? So, it's like a rubber band. It can it can go up just so much, and it can go down just so much. At a point, it's gonna have to bounce or or to peak out. So just wait for it. Low VIX, getting into a period where historically you see a little bit of weakness. Again, I'm just saying manage risk, right? This is not getting back to the chart. Like, this is not a point, right, where you would think of adding new positions and taking on more risk. This is a point where whatever you have, you have. If anything, this is where you'd think about trimming positions down and getting back down to target weight, because obviously if you had stuff which ran, your portfolio composition actually changed, right? So, I wouldn't add new risk in here. If anything, I would wait for a potential correction. I'm not talking about much, but if you got money to deploy, I wouldn't do it here. If they were mine, right? I would wait for a mild 2 to 3% type of correction and try to get a better access, better prices. But here, nah, not really. So then what? Also think about that, especially since we are seeing a lot of volumes, not only on zero DTE options, but, leverage ETFs, right? So this is a very nice point that they made in here. Even if, right, that they are taking SK Hynix as an example in here, and they are expecting it to double over the next 12 months, right? But if you're using an ETF which allows you to use leverage, in this case 2x, right? Considering the huge amount of volatility, you may take the chance that although the market overall will go up, as they say, 100%, your ETF will be fucked. And you need to understand leverage and percentages to get. It's pretty easy when you think about that, right? But volatility can really kill the returns of an ETF where you apply leverage, right? And they're just talking about 2x leverage. So I'll let you imagine what happens if people are starting to buy 3, 4, 5x leverage ETFs, right? So when you think about what happens when the market is up, 5%, right? Your ETF would be up what? Double that. Okay, and then the market is down 1%. Your ETF should be down 2%. But the more you add leverage, and the more the market went up before, well, the same percentage applied to a much larger base, it would be a much a bigger magnitude move to the downside when the market pulls back. So if you think about that and you start to repeat that process for 2, 3, 4, 7 days, 70 days, 100 days, at the end of the day, in a market which is going up, yes, but with a lot of volatility intra-week, intraday, right, on a day-by-day base, the way a 2x leverage ETF is calculated, since it's reset every single day, right, it's going to fuck you big times in the long term. So maybe, just consider not using leverage when you play these long-term bets, right? Why not, right? But, just for the sake of it. Then we got what? We had retail sales getting back in it, net buyers last week, considering what they were doing in late June. Corporate buybacks, of course, after earnings season, they are back at it. 1 trillion of authorizations. You still have the passive bid, the giant mindless robot from 401ks, which 1.6 trillion, it's no joke, right? The breadth is improving. 70% of the stocks are now above the 200 daily moving average, right? So that's good. And what else? Oh, the CTAs, so the algos, the bots, the automated trading algorithms, right? They are back at it. So, they're seeing volatility coming back down on the floor. So they are triggering back the buying routines. Conviction, well, I think, again, since they are talking about puts, if you think about the VIX, right? Where is it? Yeah, being so low, that means that the market is particularly complacent, right? So I don't know. Usually when the VIX is so low, it's a good time to buy insurance, aka puts. And you don't want to buy puts, right, when the VIX is up, because at that point you would pay a massive premium on it. And at the end of the day, if you're thinking about buying insurance, you buy it before you need it, right? If you buy it, if you find yourself to buy it when you need it, it's at that point, I guess the damage is already done, right? So, that's another thing to consider. And then what? Well, sure, the usual AI bubble type of thing. There is no return in this business. They are pouring in trillions and nothing gonna comes out of it. Well, I mean, if you just look at this sort of a recap, this is basically the amount of revenues and cash flow that they are generating. Of course, not all of them, right? Not all the companies involved are going to be winners in this AI race or build out. But if you think about the usual suspect like Microsoft, Google, or Amazon, again, as I said, narrative can be one way, but they have been proven to be the best capital allocators of the last 30 years. So betting against them, especially when they start to show up numbers, they may have, speaking about Google, they may have negative cash flow for a year or maybe two. But then when the infrastructure is built up, right, it's completed, and they're going to start to see the revenues coming in, I think that there is the opportunity to see a huge reversal in that cash flow. Instead, who is that is not going to benefit after the build out is complete? The others. Your Microns, for instance, your CoreWeave or whatever, right? So, the hyperscalers will keep on generating revenues even after the build out is complete. The others, probably not so much. So, I think there are things to consider before just saying, there's no return on investment. No. So what about these figures here? And what about these percentage increases, right? Yeah, I guess it's, look, whatever you think about it, you can think whatever you want, sure, no matter what. But psychologically, one of the most prevailing truth in markets, right, is that when everyone is expecting one thing or quoting it by the book, when all the expert agrees, right, something different tends to happen. By the same token, I'll say, if everyone is calling for a bubble, how can there be a bubble in the first place? If I know we are in a bubble, if you know we are in a bubble, if everyone knows, what are they going to do? Probably buying protection, all right? Probably building up edges so that even if we have a downturn, as we've seen, a mild correction, 4, 7, 8, even 10% in the NASDAQ, as we've seen recently, the market is not going to crash because people are not that overexposed, or at least they kind of prepared in advance, since every time you turn on TV, they tell you are in a bubble. So, you know what? I think the real problem comes when the market is completely oblivious even to the possibility we are living in a bubble. So you're going to see mainstream media stopping talking about a bubble. You're going to see people starting to disregard the base idea that you can see a bubble forming, and the narrative will be kind of disbelief. Oh, shut up. What? Depreciation? Forget it. Off balance sheet debt? That's nothing. Forget about that. I would need to see that type of behavior or that type of emotional response to kind of get to the point where, okay, I think we are getting closer and closer to the point this bubble maybe will burst. It's kind of like with Bitcoin, right? Or gold or whatever. You remember we talked about Bitcoin, we talked about gold and silver. When everyone is convinced this is just the beginning, this is just getting started, this is going to go to 200K next, when talking about Bitcoin. Or for gold, it's going to go to 10K end of year. Silver was what? It's going to go to 1,000, whatever. And then what? And then you had the blow off top, and those markets stayed in a limbo for 6 months going anywhere, right? So I'm not seeing yet bubble behavior, or late stage bubble behavior, late stage bubble psychology, late stage bubble mainstream media narrative. I'm not seeing that yet. So, nobody really knows for sure when a bubble will pop. But I'm just saying it's like the Black Swan event. How can it be a Black Swan event if everyone already knows what's going to cause it? Because if you look at the endless list of what could pop this bubble, people are going to talk to you about many different things. Private credit, right? And speaking of that, I'm not going to dive deep into it right now, but look at the type of, whether you believe it or not, memorandum of understanding Jensen from NVIDIA and a few shadow banks like BlackRock or others on Wall Street signed up to do in the future, collateralizing loans with what? NVIDIA GPUs? Would you use a GPU as collateral? Something which, it's basically the brand new shiny things today, and it's probably going to be obsolete in 2-3 years. And you are using it to collateralize a loan, which most likely would need to keep on being in existence for 5, 7, 8, 10 years, who knows? And then you are repackaging all this stuff, saying it's particularly safe. I mean, look at the collateral. Plus, NVIDIA offered up to bail out the first 25% of potential defaults. It's never going to crash. Where did I hear those type of stories before? Oh, right. It was the GFC, right? But again, no matter what, although the logic may sound good, right? Although it sounds fancy, it's actually particularly accurate if you want to identify the risk. Does it mean the risk is going to manifest itself today or next week or next month? No. So again, think about the past. Even Michael Burry, he's seen the real estate bubble, right? The real estate crash coming 2 years in advance, and he almost go bust for it because it was too early. So just, as usual, a lot of narratives, a lot of bearish porn out there, especially if you go on Twitter, but just look at price action first and look at the data secondly. All right? The market will tell you when it's time to hit the door. And I don't think we're there yet. All right? So with that, I'm going to leave you off. It's been a little bit of a shorter video, but again, price action didn't move a lot. I wasn't home yesterday. I just got back 2 hours ago. So there's really not a lot to say, not even other themes to go deeper into because didn't have the time to prepare them, right? I wish you a very good start of the next week. And of course, as usual, up until next week, be nice and be cool. Peace out.
Mm-hmm. Mm-hmm. Mm-hmm.